we're going to talk about state income tax nexus and some other compliance considerations around state income taxes. With you today is myself, Stacey Roberts. I'm a state and local tax regional director at Eide in our Denver office. Dave Smith, unfortunately, could not be with us today, but he is a senior manager in our Salt Lake City office. So feel free to keep his contact information as well, should you have any questions, and you can always feel free to contact me, and our contact information obviously here on this screen. With that, we're going to go through this just short agenda here. These are the items we're going to cover today. We're going to focus a lot on Nexus. I can tell you that I get a lot of questions about where do I need to file and why do I need to file. And as time has gone on, Nexus has really been expanded for income tax purposes. And then we're going to also layer in apportionment and kind of how that relates then to Nexus, because they do tend to work hand in hand. We're also going to talk a little bit about a little known case called Wayfair that was decided last year. It's a sales tax case. However, we are starting to see some repercussions on the income tax side. So I want to make sure that everybody's aware of some of those issues. And then we're going to just touch base on a few compliance best practices and reminders, and touch a little bit on federal tax reform and what that means for states, or at least what we know right now. Jumping right in, I'm not going to give everybody a history lesson on Nexus, but I think probably what you should keep in mind are the last two cases here towards the right of the slide. Quill, and again, these two cases, Quill and Wayfair on the right-hand side of the slide, are sales tax cases. But they are very important for a number of reasons. And even though they are sales tax cases, our income tax nexus for the states, they take cues from these cases, even though they are not, again, income tax cases. But Quill was decided in 1992, and basically the decision in Quill was that in order for a state to make a taxpayer collect a sales tax in that jurisdiction, that taxpayer had to have a physical presence. And in Quill, that was related to actually having people, employees and or reps on the ground soliciting sales. Well, then fast forward to last year and Wayfair, and as everybody probably is aware, Wayfair pretty much put the whole physical presence Nexus trigger out the window, and all taxpayers have to have now for our sales tax nexus is basically a certain amount of sales into the jurisdiction or a certain number of transactions. That's a general rule, but Wayfair was a very important case, a groundbreaking case for sales tax nexus, and really just a total game changer for sales tax nexus. But as I mentioned earlier, it does have implications on the income tax side as well. I already kind of mentioned this because of Quill and Wayfair, but physical presence nexus is still very much alive and well, even for sales tax, but it's very much alive and well for income tax as well. So physical presence basically means some kind of physical location or something like that. We're going to talk about kind of what some of those triggers are. But there's different subsets of physical presence, and this has evolved over time. Physical presence, again, when Quill was decided, was somebody on the ground, boots on the ground in a jurisdiction. Over time, that physical presence has really kind of expanded. So we've got different kinds called agency nexus, click-through nexus, affiliate nexus, and then in Wayfair, even though that's sales tax, now we've got economic presence for sales tax, but for income tax, we've had economic presence even prior to Wayfair. I think what I just want everybody to understand is that with Wayfair, the Wayfair decision, I think there's a little bit more focus on economic presence even for income tax in the states. For those of you who may be familiar with the Toys R Us and the Jeffrey trademark, that's really where economic presence and economic nexus came about, and that was also decided in the 90s. Basically, that meant that if you were just even maintaining a market and using a trademark in a jurisdiction, so that Jeffrey was the trademark of Toys R Us, and it was being used in all these different jurisdictions, and it was in a different entity, in an intangible holding company, and states then determined that that intangible holding company was doing business in those states, and so was Toys R Us. And so that started the whole economic nexus trend. But like I said, that was a case that was decided in the 90s, and so we've seen on the income tax side that economic nexus actually has been around, and now, like I said, we've got Wayfair that kind of just solidifies it even for income tax purposes. And just as an aside, for economic nexus, we've got a few states, and I have a slide on this later, that have what's called factor presence, meaning that you can sell over a certain amount into their states and have income tax nexus because of their rules. With that, I'm going to turn to our first polling question. So your company is most concerned with which type of nexus? Physical presence, economic presence, both, or none of the above? All right, both. Good, that was the majority. So I think that's true. I think everybody should be concerned with both types. Okay, moving along here. All right, so we're going to talk a little bit more about some of these concepts. And again, some of these concepts are, like these triggers are fairly obvious, but I think it's good to just be reminded of some. So physical presence, like I said earlier, almost always satisfies nexus for income tax purposes, unless the income is protected, and we'll talk a little bit about what that is, or it's de minimis. Physical presence can be satisfied by lots of different things, and some things that maybe you're not thinking about, but just having an office in a state, having a warehouse, having equipment, and owning or leasing. So I think it's important to also remember that if you're renting equipment into a jurisdiction, then that creates nexus. The issue with leasing equipment can be a nexus trigger for the lessor and the lessee, so don't forget about that. Also having inventory in a third-party warehouse. So, we've got a lot of Amazon FBA sellers having inventory sitting in an Amazon warehouse. That is nexus for income tax purposes. Also, where are your employees? Where do they work? Where do they travel to? Where do they live? And so it's important to kind of understand where they're going and what they're doing. We've got a lot of taxpayers out there that have, sales people or even just people working remotely. If they're salespeople, perhaps they have a territory and they could be traveling into multiple jurisdictions. And having that presence in a jurisdiction can be a nexus trigger. Also, don't forget about delivery of goods and company-owned trucks. There's lots of companies out there that deliver merchandise in their own trucks. Having that truck in a jurisdiction means that you have an asset in that jurisdiction, even though it could just be passing through. But if you're delivering, you're picking up goods, that can sometimes be a trigger. And then also attending trade shows. We have a lot of clients and taxpayers that attend trade shows in various locations. There's some states that have rules out there that say, oh, you can attend a trade show or be in our state for, up to 14 days, and that's not going to be a trigger for nexus. However, where states start to get or start to clamp down on it is if you're not just attending a trade show, but you actually have a booth and you're selling items on the spot. So then that becomes more of a nexus trigger, and states would generally want a filing if you're doing something like that. And again, that whole 14-day number that I just said, that is really a general rule. All the states are all over the place with respect to that. That is not something that is followed by every state. And so if you have a situation where there's trade shows being attended, particularly year over year, I would recommend looking at it and perhaps even doing some research on the state rules to see if maybe you have exceeded some kind of threshold for the number of days in the state. I mentioned this earlier, economic presence. So don't have to have any kind of physical presence in a jurisdiction. All you have to be doing is selling into a jurisdiction, and that could be enough. Again, this kind of goes back to the whole Jeffrey and Toys R Us example that I mentioned, the Jeffrey case. That's when it comes down to the use of intangibles and trademarks. However, as time has gone on, the states have said, okay, well, we're going to take this even further. And so initially it kind of started as, for the financial industries, where it was, okay, well, we've got credit card holders in a state. Well, then that would have created nexus for the credit card company and things like that. So over time, this economic nexus has really grown and expanded. And the way that the states can really get away with that, particularly for income tax purposes, is the fact that, generally speaking, these states' definitions of what doing business is in the state, and most of the states define it. I'm only aware of maybe a couple that don't actually define it. Most of the states have in their statutes or regs a definition of what is doing business, and if you were to pull those definitions, they typically make some kind of reference to maintaining a market in the state or deriving income from the state. And so that's how they can cast this wider net from an economic nexus standpoint. And then, as I mentioned earlier, there are some states that have put some parameters around it, but not every state has done that. The Multi-State Tax Commission, which is a governing body that the states can choose to be part of or not, they have some model rules that the states, again, can adopt or not. And their general rule, and if you look at this date, if you pay attention to this date, they had this general rule on what constituted factor presence in a state, and that was in 2002. So this was passed in 2002. So a long time ago now in the scheme of things. So their general rule was if a taxpayer had more than $50,000 of property in the state, or more than $50,000 of payroll in the state, or more than $500,000 of sales in the state, or if more than 25% of the total property, payroll, sales of the taxpayer in the state, if they met any of those, then they had nexus in the state. Now, again, not every state has adopted these rules. Here's the very few states that have adopted some type of factor presence rule. And again, not everybody has adopted that 50-50, 500. We've got a lot of states, right, that are single sales factor for one, but then we've got some that just have different thresholds. So, like, for example, Michigan has a completely different threshold, like 350,000. New York has a different threshold for corporations. Ohio, for their commercial activities tax, has a different threshold. So don't get too caught up in the fact that we've got this MTC model or general rule of 50-50, 500, because not all the states follow that. And I could also tell you that Washington, for the B&O tax, they have a different threshold as well. So it's important to know that we've got this, list of states that have some kind of threshold, but again, it's important to look at the different state rules to see what their particular threshold is. And another note, this list has stayed pretty static for several years. There was a point in time when we had states kind of coming on board with this, and I think they started to kind of take a step. Then a lot of other states maybe were thinking about putting some rules in place. But again, back to my remark about the doing business standards in the state, if their doing business definitions are fairly broad, then they really have the opportunity to tax more taxpayers because of the way that their rules are written. So how do you determine whether you've exceeded that threshold or not, right? Because you might be selling services, you might be selling tangible personal property. And we'll talk more about how those are sourced when we talk about apportionment. However, one other item that I wanted to throw in here, particularly in the Nexus discussion, was a federal law called Public Law 86272. And this only applies to the sale of tangible personal property. So if we have service providers out there, software providers out there, somebody who is selling some kind of, intangible of some nature, then this does not apply to you. It applies to purely sales of widgets. So this federal law is still alive and well. This law is really old from the standpoint of when it was put in place. It was put in place in the late 1950s, but it still applies. And basically what it stands for is if a taxpayer is only soliciting sales of tangible personal property in a jurisdiction, and those orders that they take are approved at the home office, which would be outside of the state, and those orders are shipped from outside of the state and to a customer in that state, then the taxpayer would have Public Law 272 protection. And what that means is that those sales would not have to be sourced to the state that they were destined to, so where the customer is. And again, like I said, this is still alive and well, and so it definitely is something to take a look at, particularly when we've got taxpayers that are, maybe even selling on Amazon, or, they're shipping from one state into, state A into state B. Maybe they're not, doing anything else but soliciting sales or something like that. So it is good to take a look at this, because perhaps you don't have to source income for income tax purposes into a jurisdiction due to this rule. A couple other caveats with this: this does not apply to sales tax, does not apply to franchise taxes. So if you have a situation where you have a state that also, so they have an income tax, but they also have a net worth tax, so something based on the balance sheet, then Public Law 6272 would not apply to the balance sheet, the tax on the balance sheet. Also doesn't apply to something like the Texas margins tax, because that's more of a gross receipts tax, or at least that's how that's classified. Similarly, the Washington B&O, that's a gross receipts tax. So this is only for pure net income-based taxes. But again, it is still alive and well. So a couple other things to keep in mind from a physical presence standpoint for Nexus. I mentioned these earlier, or at least introduced them earlier. Attributional Nexus, don't forget about this, because it could be that you have a situation where there's an affiliate or some kind of independent contractor, something like that, that's working on your behalf in a jurisdiction. Therefore, those activities of the affiliate or the related party could create nexus then for the taxpayer that's the principal in that situation. Also, for pass-through entities, just a couple things to remember. A nexus for a pass-through entity can be created by resident shareholders or members. So, for example, if you have an S-corp that perhaps is out of state, but then you have a resident shareholder of a state, and that shareholder is receiving a wage, well, that's payroll in that jurisdiction. But what if it's a partnership? What if that partner is doing some services on behalf of the partnership in that state, but the partnership itself is not doing business there? Those activities of the owners can create nexus in the states in which they reside. Also, the inverse is true, right? Because wherever the pass-through entity is doing business then creates nexus for the owners. And then our factor presence nexus rules, which I discussed a few slides ago, those also apply for the most part to pass-through entities in the states that have those rules. Other considerations, we have a lot of clients out there, depending upon what kind of business they're in, where they may need to register with a Secretary of State. So there's taxpayers out there that may need certain licenses, and I don't mean, permits, just like a sales tax license or some kind of, payroll license or something like that. I mean some kind of business license in order to do business there. Some states and some localities, in California, for example, some of the cities, they require certain licenses in order to have a location, for example. Well, in order to get those licenses, the taxpayers may have to register with the Secretary of State. And there's times even with certain taxpayers that perhaps they're just bidding on a job. So there could be engineers that want to bid on a job in another state, and in order to do that, the state requires them to register with the Secretary of State, which might seem preposterous, but we see it happen, and states have different rules with respect to what requirements for registering. And so what that can do is also then trigger an income tax filing. And where we see this mostly are the states that have minimum taxes. So for example, California, they have their $800 franchise tax. New Jersey, they have minimum taxes. And so those are two states, if you're registered with the Secretary of State, they are going to require income tax filings. They're not the only ones, but they're just a couple of examples. And then we've seen more recently, when you're even filing income tax returns, through a third party, in order to e-file, a lot of the states will want that Secretary of State number. It's just something to keep in mind. Again, we've seen some clients get caught unawares if they've registered, like I said, even just to bid on a job, and they didn't realize that then that created an income tax filing requirement. There are some states that have what's called lingering nexus or trailing nexus, where you may think that you've exited a jurisdiction, but that jurisdiction is still going to want to return for a time period, after, whether that's a year or two. So there are some states out there that have that rule. And again, some of those could be states that want that minimum tax, unfortunately. Okay, so that takes us to our second polling question. True or false? The Wayfair case determined new standards for income tax nexus. It's kind of a trick question, really. We're kind of split down the middle. Technically speaking, Wayfair was sales tax case, but like I said earlier, we are seeing some implications on the income tax side. So people are paying attention, which is good. All right, so I'm going to switch gears here, and we're going to talk about apportionment. So, you may take a look at your activities in a state and say, okay, well, I've got nexus, just based upon maybe physical presence, for example. Well, then the next step, right, is to determine, okay, well, then how much of, my federal taxable income then do I need to source or actually, apportion to that jurisdiction? And also, the reason why we want to talk about apportionment is from a sourcing perspective, so that for factor presence states, for example, are you exceeding thresholds? Or even if you're a service-based business, are you technically deriving income from their state? And it's all related to how things are sourced, particularly for the sales factor. And so that's why this is important, to kind of marry these two concepts together, the nexus and the apportionment. So as time has gone on, apportionment has changed. And a lot of that is because our economy has changed. The original apportionment formula was property, payroll, evenly weighted property, payroll, and sales. So basically, your property in the state plus your payroll in the state plus your sales in the state divided by 3. Well, over time, like I said, with the change of the economy and the fact that, we're going more online, more digital, people don't have to necessarily be boots on the ground drumming up business, the apportionment formulas for the states have also adapted to that. And so what we're seeing is that we're going more heavily weighted sales factor, and we've got a ton of states now that are single sales factor, or at least have, phased it in or in the process of phasing it in as a single sales factor. This slide is a little busy, but this is the state apportionment formulas, the general state apportionment formulas for corporations for 2019. Keep in mind that for flow-through entities, these may not be the apportionment formulas. Some of the states will use like an evenly weighted 3-factor still for partnerships and flow-throughs. So don't rely on this chart necessarily if you have a flow-through situation. But I think what this goes to show is that we've got a lot of states that are single sales and or double weighted or triple weighted sales, et cetera. So it just goes to show that more and more states have moved in that direction. Okay, so I'm going to switch gears and kind of talk about sales and services, because we've got a lot of service-based industries out there, myself included, right? I'm in the professional services industry. And as time has gone on, and the fact that we don't necessarily have to be performing a service in a jurisdiction for a client, we can be remotely doing that, we could be doing that anywhere. The states too have taken a look at that and changed their rules on how to source services. But there are some states out there that still source services kind of the traditional way. And so we've got 2 different ways really that states will source services, source the sales of services. One is based on cost performance, and then the other is based on, it's a market-based sourcing. Cost performance, we're kind of moving away from this. However, there are still states out there that source under this method. Basically, if the general rule is what we call an all or nothing rule, which says, if the greater cost performing the service occurs in a jurisdiction, then the jurisdiction would get 100% of that sale. if you have a situation where less than 50% of the costs of the service are performed in that state, it's an all or nothing state, then they would get zero. But then we've got some states out there that are pro rata sourcing, meaning that it's basically on the time spent in the state performing that service. Colorado has historically been a pro rata sourcing state up until this year. So again, we've got a few states out there that still follow these rules, but we're seeing a shift to market-based sourcing, and basically the market-based sourcing states, now there's a lot of different flavors of it, but a lot of the states say that the sale of the service would be sourced to their state if the benefit of that service was received in their state. So if I was performing a service for a California-based company, then California would say, okay, well, the benefit of my service is being received by in California because the customer is in California. Not every state follows that rule. There are some states that say it's where the customer is billed. Some states say where the customer's marketplace is located. And then there's also states, kind of like California is actually one of them, that they have what we call a cascading rule, that maybe if you don't know where the customer is located, then you will look and see where the billing address is. Or if you don't know where that is, then you move down to another threshold of, or another rule of where the contract was signed, et cetera. So there are situations where maybe we don't know where the benefit of the service is received. I had a client that they sold software as a service, and actually Google was one of their clients. And Google purchased their software to use themselves, but even though Google is headquartered in California, they have offices, as many of you probably are aware, all over the country. So where really is the benefit of that service received, right? So because they would also do, some, even though they were selling basically the right to use the software, there was also some services associated with that. So I don't know if I would argue that I think I would argue against that California would get all of that just because they're, might have paid the bill out of California. So those are some of the things to keep in mind with respect to these rules. So here's our market-based sourcing states, and this list, I can tell you, continues to get longer. And as I mentioned, not everybody is following the same rule with respect to, is it where the benefit of the service is received, or is it some other kind of test? We have a few states here that are that have come on board recently. I mentioned Colorado. I physically sit in Denver, and Colorado changed this year. New Jersey changed this year, and we've got Missouri that is coming on board. So this list continues to grow. But again, like I said, it's not a one-size-fits-all. So if you have a situation where you're a service provider and wondering, how do I determine if my sale should be in, DC, it's important to look at DC's rules to see what those are. Okay, and that brings us to our next polling question. In most states, sales of services and sales of tangible personal property are sourced similarly. All right, ooh, we are even. They are not, unfortunately, sourced similarly. As I mentioned, sales of services sourced as basically cost performance or market-based. Sales of tangible personal property, there are some general rules on how they should be sourced. Generally speaking, sales of tangible personal property are sourced to the destination of where the property is delivered or shipped, regardless of kind of the FOB point, any of the where title passes, things of that nature. I get that question a lot because in the sales tax world, sometimes where title and possession occur can matter for sourcing, but most of the states for income tax purposes make it clear that it's where it's delivered or shipped regardless of those shipping terms. Now, there are some states that have this other piece of the rule, meaning that if it's shipped from an office, store, warehouse, factory, or other place of storage in the state, and the purchaser is the U.S. government, or the taxpayer is not taxable in the state of the purchaser, then it needs to come back to origination, and that's what's called the throwback rule. So we're going to kind of just break that down a little bit. Not every state has this rule, and I have a slide on who does, but this is kind of a little bit more complex rule, but I think if I maybe break it down a little bit for everybody and give some examples, hopefully if you're not familiar with this rule, then it'll make more sense. So if you have a situation, and Colorado has throwback, so I'll use Colorado as an example. So if tangible personal property, if goods are shipped from Colorado to out of state, then we have to look and see, is the taxpayer taxable in the state that the customer is in? How do you determine what is taxable in the state of the purchaser? So how do I know if I'm taxable in the state that the items were shipped to? Well, taxable in the state of the purchaser is generally defined, and basically it means that if the taxpayer pays some kind of tax in that jurisdiction that the customer is in. So it could be an income tax, it can be a franchise tax, it could be, you know, a privilege tax or corporate stock tax. Any of those kind of balance sheet type taxes could apply. Or if that state has the jurisdiction to tax the taxpayer, but they don't impose an income tax. So an example of that would be if you have a taxpayer that ships to Wyoming. Wyoming does not have a net income-based tax. But let's say our taxpayer has NEXUS in Wyoming, is paying sales tax or registered for sales tax, has employees in Wyoming. Well, Wyoming doesn't impose a net income tax. However, that taxpayer has NEXUS in Wyoming. Therefore, if that sale was from Colorado to Wyoming, then that sale would not have to be thrown back to Colorado because the taxpayer has NEXUS in Wyoming. Now, if the taxpayer did not have NEXUS in Wyoming, then that sale would have to come back to Colorado. Not every state has throwback, but it's an important concept when you're selling tangible personal property and you're shipping it from multiple locations, because you may or may not have to throw it back to origination, depending upon whether the state has that rule, and again, depending upon whether the taxpayer has NEXUS in the jurisdiction in which it's shipped. And I can tell you that this may seem like a very complicated concept, but auditors look at this, and auditors will want proof. They'll want copies of returns filed in other jurisdictions in order to support the fact that items were, that sales were thrown back or not. So I'm going to switch gears a little bit and talk about Wayfair. I know I've talked about Wayfair. It's kind of hard in state and local tax not to talk about Wayfair. And I think it's important for people to understand that there is a trickle down effect in income tax due to Wayfair. So just quickly, and I'm not going to go through all of the rules, but just for those of you who may not be keeping score on what's going on with Wayfair, but since June 21st of 2018, pretty much every state, I think maybe we've got 3 or 4 that actually have not introduced legislation or passed legislation with some kind of economic nexus standards for sales tax purposes. We have a lot of states that are in kind of this OR category here over on the left, the $100,000 of sales into the jurisdiction or 200 transactions. There are a couple states that are in the AND category, meaning that you have to meet both prongs in order to have economic nexus. Then there's some states out there that are kind of choosing whether you go ahead and register to collect, or you are going through and complying with their notice and reporting requirements. I can tell you that a lot of states are kind of moving away from the notice and reporting. So we've seen some changes since Wayfair was decided, and in the legislative sessions that just occurred earlier this year, we've seen some states either change their thresholds, we've seen states move away from the transaction numbers, so meaning maybe they don't have that 200 transaction threshold anymore as part of their, and then we've got some states still out there that have their own unique thresholds. So still a little bit of a moving target, but the states are starting to, we have more states that are on board and they're refining, I guess, for lack of a better word, they're kind of refining their rules. So what this is doing is, clearly and rightfully so, we've got remote sellers that are looking at their sales, you know, on a 12-month period and saying, okay, I've exceeded thresholds in these states, so I'm going to do the right thing. I'm going to go and I'm going to get registered. I'm going to start collecting. Well, the issue there is that you're registering for a sales tax account. And so what we've seen and what we'll probably continue to see once the states kind of get more, I would say, a hold of, or, you know, get their arms around more of the registrations, because as you can imagine, and maybe even for some of you on this call, you know, you're getting registered, again, trying to do the right thing, get compliant, start charging the tax, but the states are inundated with registration, so they're, you know, they're struggling, they're trying to keep up. But what we're seeing, and what we'll, like I said, what I think what we will continue to see is the fact that the states are going to start to match up accounts and say, okay, and we see this already. So, and maybe some of you have experienced this pain where you've got payroll in a jurisdiction, so you've got employees, you're paying payroll taxes, maybe not filing, you know, all of the other state returns that you needed to at the time, and you've gotten a notice because they've matched up accounts and said, okay, well, you're paying payroll taxes and withholding. Why are you not filing income tax returns? Or why do you not have a sales tax license? So same concept, where now we've got sales tax registrations occurring, and so we're starting to see where states are sending out inquiries in response and saying, okay, we don't see you have an income tax return on file. You know, what's your nexus? Or they're just sending out nexus questionnaires in the wake of Wayfair, because as we all know, Wayfair stands for the fact that you're a remote seller selling into a jurisdiction and you don't have physical presence in that jurisdiction. Well, what if you did prior? And so that's what the states are fishing for. They're sending out nexus questionnaires saying, okay, do you have, you know, what have been your prior nexus triggers? And so we're seeing a lot of that, and so we're trying to be thoughtful about how we approach those. And so I just want to let everybody else on the call know that, you know, this is an evolving area, and if you haven't heard from some states yet, you might hear from them. Again, I think that they're trying to catch up in some ways. I mentioned earlier that doing business, you know, quote unquote, doing business is broadly defined in the states. And so, you know, the states are looking at it and saying, okay, you're registering for sales tax, right? And you're basically freely admitting that you're deriving income from our state. So therefore, where is your income tax return? So that's how, you know, they're also kind of able to marry these up. This is also important for inbound companies. So we have, you know, a lot of companies that are, you know, offshore and they're selling into the US. It impacts them as well. So, you know, there's some broader implications here for income tax purposes, and not sure that, you know, when Wayfair was passed, everybody was thinking about that. But I think the states are getting smarter about it and taking advantage of their rules with respect to how they define doing business, and then sending the inquiries on the income tax side. So, having said all that, though, what if you are selling, you know, a widget? You know, you're selling a tangible good. Don't forget that Public Law 6272 protection could apply. So even though you might be getting this inquiry, or, you know, you might be thinking, wow, should I be doing something about income tax? You know, don't forget to layer that in, because you may not have to source any income, or you may not have to file an income tax return due to Public Law 6272. Okay, that brings us to our fourth polling question. Economic nexus thresholds generally include the following: sales in the state, number of transactions in the state, both A and B, none of the above. Okay, good. Okay, so all right, so we've talked about nexus, and again, it may not be so scary, right? I mean, my conversations that I have with clients a lot is around nexus, but then the next step is, okay, well, do you really have a liability, right? So, you know, we've got these NEXUS rules that are very broad. They're casting a wide net. We've got Wayfair that now we have to kind of also think about or have in the back of our mind, even for income tax purposes. But at the end of the day, you know, once we take a look at kind of our apportionment and, you know, times of tax rate, et cetera, layer in public liability 272, we may not have, you know, a scary liability. And so I think I just want to make sure that everybody's kind of aware of that and just thinks about that, because I think a lot of my conversations with clients are that it's NEXUS is so scary, but we have to take it a step further because perhaps our liability is not that much. So with that, then I'm going to just kind of switch gears a little bit and just kind of talk about some compliance best practices and tools. And some of these things are obvious, but I think it's always a good reminder. So, you know, on an annual basis, because for income tax purposes, pretty much NEXUS is an annual, you know, or annual review, right? Once you have NEXUS in a state, then you're going to file for the entire year. That may not necessarily be true on the sales tax side, but, you know, for income tax, you're going to file for the year. So it's important, you know, on an annual basis to kind of take a look at the footprint. Okay, where do we have property? Which may seem like something obvious, but, you know, big companies even may not realize that they've got leased equipment somewhere, or, you know, or it suddenly is in another jurisdiction that maybe the tax department wasn't aware of, that kind of thing. So it's really important to just kind of ask those questions. Employees and contractors, reps, again, it doesn't have to be a W-2'd individual that's creating NEXUS in a jurisdiction. Independent contractors and reps, they create NEXUS just as easily as an employee. So where are they going? Where are they traveling? Important to ask those questions. And then consider the nature of the transactions and relations in the state. And this really kind of has to go with, if anybody's had to fill out a NEXUS questionnaire, there's usually some questions about how taxpayers are getting the business in the state. You know, how they're kind of advertising, you know, how are they, and again, that is all going back to how they're quote unquote, or if they are quote unquote, maintaining a market. And that's what those questions are really geared toward. So it's really kind of taking a look at, you know, what are we doing in these jurisdictions and how are we getting that work? And again, every year we need to look at those. And I have these questions, you know, I have these meetings with clients pretty much every year where we talk about, you know, when we're getting ready to do extensions, for example, or, you know, if they file on time, you know, so in the spring, we're taking a look at the prior year activities and going, okay, you know, what's new? Is there anything new? Has anything changed? And so then we can make some decisions on where we're going to file. So if there's NEXUS in a new jurisdiction, you know, let's file. Also, if we've left a jurisdiction, let's close the accounts if you know, that's a thing, or file a final return, things like that. I can't stress enough about answering NEXUS questionnaires and responding to notices. I mean, gone are the time, you know, is the time of where you might get a notice from a state and never hear from them if you did nothing with it. Those days are gone for the most part. It's very rare for that to occur. And if you think that, you know, you haven't heard from somebody in 4 months, that you're not going to hear from them again, chances are you're going to hear from them again. It's just going to be, you know, maybe 6 months later. They don't forget. And if there's some skeletons in the closet, then that just means that, you know, you could have some additional penalties and interest associated with an assessment. In that vein, if you are looking at activities, you know, so if clients are looking at activities, you know, kind of taking a look at the past. Again, with Wayfair, I think we've seen a lot more of this. I have a lot of clients that are taking a look at the past and saying, okay, actually, we've had presence, physical presence in these jurisdictions, and if we're going to register, then that might open us up. So it's taking a look at those past and activities, and then quantifying any kind of exposure. And if there is exposure that is is something that's, you know, of a number that makes management uncomfortable, then there is the opportunity to do voluntary disclosures. That's what the VDA is here on the screen. Voluntary disclosures are really good vehicles for becoming compliant in a jurisdiction. For those of you not familiar with what they are, you basically are going to a state and saying, hey, I want to come clean, I want to become compliant, and what in return the state will limit the look-back period to, generally for income tax purposes, it can be 3 or 4 years. For sales tax, it's generally 3. There are a few states that will go back further than that, but they will also usually abate penalties. There's some states that will also abate interest. Texas is one of those. So they're really good programs to consider, because basically what you're doing is, paying tax through, back 3 or 4 years, nothing prior to that, and then abating penalties, paying the interest, and then basically you're in good standing and able to file on a go-forward basis. And states really like those programs and like for taxpayers to apply for those, because they get a new taxpayer, and they are really good programs, and every state has one. There are states out there that will run amnesty programs that are different from VDAs. Generally, they run they will run for a period of time. Amnesty programs sometimes can have terms that are not as good as VDAs, but they do sometimes cover additional taxes. So there's some states out there, for example, that maybe you can't do an individual income tax VDA, but you could under their amnesty program. Again, those do not run all the time. And I caution everybody, just pay attention to the terms of those, because again, they may not be as good as doing a VDA. So those are really good vehicles, things to keep in mind if you are taking a look at the past and realize that maybe there's some unpaid liabilities out there. Okay, just a couple quick things on conformity to federal tax reform. I think everybody probably, if you're familiar with state income tax and kind of the starting point, generally speaking, the states conform or not to the IRC. There's some states that are fixed date conformity, so it's as of a specific date, whether that's January 1st, 2015 or something of that nature. And there's still some of those states out there that, have not updated to, the most recent IRC. So that's where you see some of these adjustments coming through for prior years before tax reform, with like depreciation and things like that. But again, keep in mind that we've got some that are, have not changed even from like 2015. And so any of the tax reform provisions, most recent tax reform provisions, would not be anything they would follow. Then there's states out there that are rolling conformity. So, they automatically adopt the new IRC code as changes occur. There are states that on an annual basis, they basically get together and they vote and determine what, due date or what fixed conformity date they're going to choose. And they do that on an annual basis. And then there's some states out there that are just kind of picking and choosing which provisions of the IRC they conform to. And I think I do a lot of work in California, and California, even though they say they're fixed date conformity, I would tend to put them in the selective conformity because they don't conform to a lot. So the states have started, I was really kind of putting out some kind of guidance on whether they're conforming or not to specific major provisions. I'll say on the 965, so if this is something that, that is, affects anybody here on the call, most of the states have, given some guidance on what they're doing with 965. The other provisions on here, we're still seeing states putting out guidance. And so this is a little bit of a moving target, and we will continue to see states put out, guidance on whether they conform or not. I will tell you that we have some pretty decent tools, research databases that, keep track of this. And so if you're struggling with what to do with some of these provisions, give us a call and we can hopefully help you with your specific state issue with that. That takes care of my piece of the presentation. Amy, I'll go ahead and hand it over to you to announce the rest of our business trends webinars and take questions.
Okay. Sounds good. So yes, if you're interested in joining any more of our presentations, we do have the list of upcoming webinars for July. Just go to our website and you can register for any one of those. And then for the questions that have come in, The first one, how does Wayfair affect research and development grants or contracts?
Ooh, I guess I'm not exactly sure. I might need to take that one offline because I'm not exactly sure if that's maybe a taxability question or if that's more of a nexus question, meaning if you have a contract going on in a jurisdiction, whether Wayfair would apply to that. And I would say if that's the question, then absolutely yes. If there's work being done in a jurisdiction or selling some kind of research and development project, Wayfair applies to all kinds of products and services. So if that's the question, then yes, absolutely Wayfair, those rules would apply. Now, keep in mind with Wayfair, Wayfair is just Nexus. And so all of the other rules apply with respect to, is it taxable, things of that nature. That's just a Nexus trigger. And then all the rest of the sales tax rules apply. If it's, like I said, if it's taxable, is it a wholesale transaction? Is it a service, et cetera? So keep that in mind. If I didn't answer that question, please email me though, because I want to make sure that I'm answering the questions that are being asked.
Okay. Is there a map that shows which states fall into the 4 basic styles of economic nexus laws?
So we have a chart on our website. I should have put a link to it here, but if you go to eidbailey.com and go into the state and local tax services area, we have a insight that's called, I think it's Wayfair, or it refers to Wayfair, Supreme Court case, and then we have a chart in there. So it's not a map, but it is a chart. And so it will show all of the states, their thresholds, and their enforcement dates. So if you're not able to find it, please email me and I can get it to you.
Okay, the next question. It's a little long here. On your menu bar, do you see the Q&A box?
Yes, yep, I have it up. So is this the economic question?
Yeah, the anonymous attendee.
Yeah, so it says, in regards to economic nexus, do you have to determine if the TPP is a taxable item in that state before determining if your client meets the thresholds in that state? Okay, so that's a good question. So this is related to Wayfair. So generally speaking, we're seeing that it's gross sales. So that magical number, if you exceed $100,000 or whatever the magical number is, the sales that count towards that are gross. So, you could have a situation where it's, an exempt sale or a sale for resale, a wholesaler, but technically speaking, the state would say, well, those sales count even though they're wholesale or exempt, and then the expectation would be to register and then file 0 returns. That would be the technically correct, and what the states would expect. So I think that answers that question. And then, with Wayfair, the fact that, you could have a situation where you're a wholesaler or it's exempt, maybe it's manufacturing equipment. I can't stress enough to get exemption certificates, because auditors look for those, and, get all your documentation so that you have it there should you get audited. Is that all the questions at this point?
That is all the questions at this point.
Okay. Anything else?
No, that is it. Thank you everyone for attending, and thank you, Stacy, and have a great day, guys.
Yeah, thanks everybody.